How about an investment strategy that delivered nearly 1,160% returns compared to the market portfolio of 30.54% return over a 12-year period, from June of 1999 to June of 2011? It would mean a lot if you would smash that like button and subscribe. Also, feel free to share this video if you find it helpful with friends or family. The backtest period of time for this investment strategy was definitely not a good time to be invested in stocks, but it turned out pretty well. The 12-year period that was tested included a stock market bubble in 1999, 2 recessions, the year 2001, 2008 through 2009, and 2 bear markets, 2001 to 2003, 2007 to 2009. In spite of all the substantial movements, it was essentially a sideways market. There are some groundbreaking insights that we can glean from a study done by ValueSignals.com. The link to the study is below. They conducted extensive backtesting on various investment strategies, and the results are truly eye-opening. Prepare to challenge your preconceptions and discover the power of a 2-factor strategy, momentum and value together, to create huge returns. Here's where it gets really interesting, especially for value investors. The research revealed that price movements over the previous 6 and 12-month periods were key factors in the top-performing 2-factor strategies that were tested. This finding challenges the classical value investing approach, which suggests that declining share prices indicate attractive investment opportunities. The backtesting revealed that while valuation still matters, it needs to be applied differently. Instead of solely focusing on declining prices, it's recommended to identify the 20% of companies that have experienced the greatest price increases over the past 6 months. Next, sort those companies by price to book value and select the 30 to 40 companies with the lowest ratios. This revised approach balances valuation and price momentum, so you get price to book and price momentum together, value and growth. Now, you might be wondering, what does all of this mean for your future investment returns? While no one can predict the future with absolute certainty, we have a pretty good idea based on historical data. Keep in mind that these strategies have thrived during one of the worst 12-year periods in stock market performance. Over the next 10 years, this top-performing strategy, which involved buying the lowest 20% of companies by book value among the 20% with the greatest price increases, may not outperform other strategies. However, it is likely to continue generating outstanding market-beating returns. Over that 12-year period of backtesting, the strategy delivered nearly 1,160% returns compared to the market portfolio's 30.54% return. Even if it falls to position 20 among the strategies that were backtested with a total return of 670%, it would still outperform the majority of investment funds worldwide. Now, a valid concern you might have is whether these strategies will lose their effectiveness if everyone starts using them. Now, this fear stems from the assumption that increased demand would drive up prices, eliminating undervalued opportunities. However, history suggests a different outcome. Renowned investor Joel Greenblatt highlighted in his book, The Little Book That Still Beats the Market, that these strategies don't work all the time. As soon as they stop working, investors tend to abandon them, often at the worst possible time. Ironically, this exodus occurs just before the strategies would begin outperforming the market once again. The best performing strategy that was backtested only outperformed the market 83% of the time and experienced negative returns in 3 of the 12 years backtested. It's highly likely that investors abandoned the strategy precisely during one of those less successful periods. So how do we come up with this portfolio? Once a year? Twice a year? Every quarter? Well, here's how I do it with GuruFocus.com. As you can see, this is the criteria that I put in for the initial scan. Then we take the top 20% of these stocks based on momentum and sort by lowest price to book. That's when we grab the top 30 or 40 stocks, and there's our portfolio. We hold the portfolio for a year, sell the losers right before it becomes a full year, so we can take advantage of tax loss harvesting, and then sell the winners after it's been a full year, so we can take advantage of long-term capital gains tax. And then we run the scan again and start all over. Check back each quarter to see the new portfolio list and to track the performance of previous portfolios. Before we conclude, I'd like to emphasize a critical point. Following these strategies isn't a walk in the park. When you see the companies they suggest, you might be tempted to analyze them individually and make judgments. However, I urge you to just consider diversification as a key factor in achieving outstanding performance. Instead of investing in one or two companies, it's recommended allocating your investments across the minimum of 30 to 40 companies. Now, this approach ensures that even if one or two companies faces challenges or goes bankrupt, the others will likely thrive, leading to exceptional overall performance. And there you have it, fellow investors. The power of a two-factor strategy of momentum combined with price to book and the potential to deliver exceptional returns has been unveiled. Remember, while these strategies may evolve over time, their historical track record suggests that they will remain among the top performers. Keep an open mind, diversify your portfolio, and embrace the ever-changing dynamics of the market. If you found this video helpful, make sure to smash the like button and subscribe to our channel for more insightful content. Happy investing!